why investors use it, how the formula works, why it is so powerful for long-term wealth building, and how everyday Americans can use this simple rule to understand how money grows over time. If you want to build wealth, there is one simple idea that can completely change how you look at money. Most people think investing is complicated. They believe you need advanced math, a finance degree, or hours of research every day. But the truth is, some of the most powerful investing concepts are incredibly simple. One of those concepts is the rule of 72. This is a quick mental shortcut used by investors, financial advisors, and economists to estimate how long it will take for an investment to double in value. And once you understand this rule, you start seeing money and time very differently. Here is the idea in the simplest way possible. The rule of 72 helps you estimate how many years it will take for your investment to double based on the annual rate of return. The formula is extremely simple. You take the number 72 and divide it by the annual interest rate or return rate. The result tells you approximately how many years it will take for your money to double. This is not a complicated financial model. It is simply a fast way to understand the power of compounding without needing a calculator. 72 divided by, let's walk through a simple example so you can see how powerful this is. Imagine you invest money and earn an average return of 8% per year. Using the rule of 72, you divide 72 by 8. The answer is 9. That means your investment would double in about 9 years. If you invested $10,000 today and earned around 8% annually, it would grow to roughly $20,000 in about 9 years. Without doing complex calculations, you immediately understand the timeline of your investment growth. Now let's look at another example. Suppose you find an investment that averages 6% per year. If you divide 72 by 6, the result is 12. That means your money doubles in about 12 years. Already you can see how small difference in returns change the timeline dramatically. 2% may not sound like much when you hear it casually, but when you look at how it affects compounding, the difference becomes massive over decades. This is why the rule of 72 is such a powerful thinking tool. It allows you to instantly compare investments. Instead of getting lost in complicated projections, you can quickly estimate the doubling time of your money. Investors constantly use this rule to understand how different rates of return affect long-term wealth. It helps you visualize time in the world of investing, and time is the single most important factor in wealth building. Now, here is something important to understand. The rule of 72 is not meant to give you perfect predictions. It is an approximation. Real investments fluctuate. Stock market returns vary from year to year. Interest rates change. But even with those variations, the rule of 72 remains incredibly useful because it gives you a fast mental framework. It allows you to understand the relationship between time, interest rates, and compounding in just a few seconds. Another interesting place where the rule of 72 shows up is inflation. Inflation quietly reduces the purchasing power of money over time. Using the same formula, you can estimate how quickly inflation cuts the value of money in half. For example, if inflation averages 3% per year, dividing 72 by 3 gives you 24. That means the purchasing power of money would be cut in half in about 24 years. Suddenly, inflation does not feel like a small number anymore. It becomes a long-term force that slowly erodes wealth. This is why smart investors understand that simply saving money is not enough. If your savings are growing slower than inflation, your real wealth is actually shrinking. The rule of 72 helps you see this clearly. It shows you that investing is not just about making money. It is about staying ahead of the silent forces that reduce the value of money over time. When you begin thinking in terms of doubling cycles, your entire financial mindset starts to shift. Instead of chasing quick wins or short term speculation, you begin focusing on sustainable long term growth. You start asking smarter questions. What rate of return can I realistically achieve over decades? How many times can my portfolio double before retirement? How early should I start investing to maximize compounding? These questions are exactly what separate disciplined investors from everyone else. The rule of 72 is not just a math shortcut, it is a way of thinking about money, time, and growth. And once you understand this idea, it becomes much easier to see why long term investing has created so many millionaires. We are going to cover how the rule of 72 applies to real investments in the United States, how different return rates affect the doubling time of money, how stock market returns compare with savings accounts, and how investors use this rule to think about long term wealth building. To really understand the power of the rule of 72, we need to look at how it works in real investing situations. In the United States, different types of investments produce different average returns over long periods of time. For example, traditional savings accounts often produce around 2 to 4% annually, depending on interest rates. High yield savings accounts may sometimes reach 4 or 5% in certain economic environments. Meanwhile, long term stock market investments have historically averaged closer to 7 to 10% annually when measured over several decades. When you apply the rule of 72 to these numbers, the difference in long term wealth becomes extremely clear. Let's start with something simple, like a savings account earning 4% annually. Using the rule of 72, you divide 72 by 4 and you get 18. That means money in that account would take roughly 18 years to double. Now think about that timeline for a moment. If you deposit $10,000 and earn around 4% per year, it would take about 18 years to reach $20,000. For many people, that feels like a very slow process, especially when inflation is slowly reducing the purchasing power of money at the same time. Now, compare that to long term stock market investing. Historically, broad market index funds in the United States have delivered average returns of around 8% after inflation when measured over long periods. When you apply the rule of 72 to 8%, you divide 72 by 8, and the answer is 9. That means money doubles approximately every 9 years instead of every 18 years. Right away, you can see the difference. The same $10,000 invested at 8% could become 20,000 in about 9 years, 40,000 in 18 years, and 80,000 in 27 years if the growth continued. This is why long term investors focus so heavily on equity investments like index funds. They are not chasing quick wins or short term speculation. They are simply trying to achieve consistent returns that allow compounding to work over time. When you think about your investments in terms of doubling cycles instead of just percentages, the entire strategy becomes much clearer. Every 9 years, your portfolio has the potential to double if the average return holds, and that compounding effect becomes extremely powerful over multiple decades. Let's imagine a long term scenario that many investors in the United States actually follow. Suppose someone begins investing at age 25 and earns an average return of 8% annually. Using the rule of 72, their investments could double roughly every 9 years. That means By age 34, their portfolio could be twice as large. By age 43, it could double again. By age 52, it could double again. And by age 61, it could potentially double one more time. Over a 35-year investing career, that could mean four doubling cycles. Now think about what that means in real numbers. If someone invested $20,000 early in their career and allowed it to double four times, that investment could grow to roughly $320,000 without adding any additional money. This example shows why starting early is so important. The earlier you begin investing, the more doubling cycles your money has time to go through. Each cycle dramatically increases the total value of the investment. Another interesting way investors use the rule of 72 is when comparing different strategies. For example, if one investment strategy produces a 6% return and another produces 9%, the difference might not seem dramatic on paper, but the rule of 72 shows the real impact immediately. At 6%, money doubles every 12 years. At 9%, money doubles every 8 years. Over 30 years, that difference means your portfolio might double two times instead of nearly four times. That small increase in return creates a massive difference in long term wealth. This is why experienced investors focus so much on consistency rather than trying to predict the market every year. They understand that maintaining a strong long term return is far more important than chasing unpredictable gains. The rule of 72 gives them a quick way to measure how effective their strategy could be over time. Instead of asking whether a return sounds impressive, they ask a much more practical question: how quickly does this rate of return double my money? In this part, we will cover the most important practical lesson of the rule of 72, how early investing multiplies wealth, how compounding accelerates over time, and how everyday investors in the United States can actually use this rule to build on long-term financial security. The biggest takeaway from the rule of 72 is not just the formula itself. The real lesson is understanding how powerful time and compounding can be when they work together. Many people believe wealth comes from making one perfect investment or finding some secret strategy that beats the market. In reality, most long term wealth in the United States has been built through consistent investing over many years. The rule of 72 simply gives you a quick way to see how time turns small investments into much larger amounts. To understand this, imagine two investors who both eventually invest the same amount of money but start at different times. The first person begins investing at age 25, while the second person waits until age 35. If both investors earn roughly 8% annually, the rule of 72 tells us their money doubles about every 9 years. The investor who started at 25 gets an entire extra doubling cycle before retirement. That single extra cycle can mean the difference between a portfolio worth a few $100,000 and one worth well over $1 million. The lesson here is simple but powerful. Starting early is often more important than investing large amounts later. Another key insight is that compounding grows faster the longer it runs. In the early years, growth can feel slow because the investment base is small. Many new investors get discouraged during this stage because the gains look modest. But once the portfolio grows larger, each doubling cycle adds significantly more value than the previous one. For example, growing from 10,000 to 20,000 may take nearly a decade at 8%. But once the investment reaches 100,000, the next doubling adds another $100,000. Later, a portfolio of 500,000 doubling to 1 million represents an enormous increase, even though the percentage return is exactly the same. This is why experienced investors stay focused on long term consistency instead of short term market movements. The market will always have ups and downs. Some years deliver strong returns, and others bring temporary declines. But investors who stay disciplined and continue investing allow compounding to work through those cycles. Over decades, the overall trend of productive businesses and the broader economy has historically moved upward, and long term investors benefit from that growth. The rule of 72 also helps investors set realistic expectations. When you understand how doubling cycles work, you stop chasing unrealistic promises of quick wealth. If someone claims they can double your money in 1 year, the rule of 72 immediately tells you what kind of return that would require. 72 divided by 1 means a 72% annual return. That is an extremely rare result, and usually a sign that something is too risky or too good to be true. This simple mental check helps investors avoid many of the common mistakes that destroy wealth. Another practical way to use the rule of 72 is when evaluating everyday financial decisions. Whether you are comparing retirement accounts, index funds, real estate investments, or even interest rates on savings products, this rule allows you to quickly estimate how efficiently your money could grow. Instead of focusing only on percentages, you start thinking about time. How long does it take for my money to double? And how many times can that happen during my investing lifetime? When people begin thinking this way, their financial behavior usually changes. They become more patient investors, they focus more on long term assets, and they understand why consistent investing matters so much. Even small monthly contributions can grow dramatically when they pass through several doubling cycles. Over 20 or 30 years, those cycles can transform modest savings into a substantial portfolio. The bottom line is that the rule of 72